Managing risk. Introduction to the module. When we use expressions like win-loss ratio, it almost implies that the two sides of this comparison are equal but opposite. They are not. Psychologists suggest that for the same money amount, losing brings us approximately twice the pain as winning brings pleasure. Yet, losing is as integral a part of trading as winning. Indeed, when you take a position, you will likely spend half your time, or more, doing precisely this. So your actions during this time will have a considerable impact on your long-term success, but also be the most challenging. This module will help you better manage risk by focusing on your behavior when you lose. Using a stop-loss order. Exiting a losing engagement is distressing because, firstly, it confirms that our original idea was wrong. Secondly, we secretly fear that, as soon as we exit, the market will suddenly reverse direction again and rush towards our original objective. We dread the thought of exiting at precisely the worst moment and thus following one wrong decision with another. So, our reluctance to admit a mistake and the anticipation of our future regret conspire to make loss-taking so painful. This course has dwelt considerably on the importance of the stop-loss order because, apart from the timely entry into positions, it is the single tool that will ensure your long-term survival in the market. It does this by rendering the exit as painless as possible. A stop-loss order takes the execution out of our hands. We can scream, cry and mourn over our losses as much as we like afterwards, but we will have taken the necessary action. Placing a stop-loss order. The ideal stop-loss level is a price which, if traded, would demonstrate that our original idea was wrong. If we are relying on nearby demand to justify a long position, for example, the stop-loss must be set at a price slightly below that support level. Any breach of the support proves that the expected demand was insufficient. We were wrong. A second prerequisite for a stop-loss is that it must not be a recently traded price. In the example above, had the currency changed hands recently at the proposed stop-loss level, then demand at higher prices would already have proved itself inadequate. In short, a move to the stop-loss should represent a development that is both unexpected and new. Beware of overtrading. Overtrading means taking on board more positions than the strategy can justify. Traders sometimes overtrade when they are bored, impatient, or are desperate after a loss to make the losses back. However, each position is an exposure to risk. As capital is finite, the number of potential positions is limited. Each one must have the best opportunity for success. Unlike the long-term market, participants who must chase export deals and international investments, short-term traders can, and must, wait for the best trading opportunities to arise. Reducing transaction costs. Forex trading is relatively cheap, but it is not free. Opening and closing a position involves paying at least the bid-offer spread. There is also the cost of slippage if the exit takes place in a market that is volatile or lacks liquidity. Remember, the sum of your winning positions must pay for all the losers and all the transaction costs. It is inescapable that profit objectives must stand in reasonable proportion to the typical bid-offer spread. Consider two traders, X and Y, active in a market where the typical bid-offer spread is 0.05%. Both traders have a win-loss ratio of 1:1 and a reward-risk ratio of 2:1. Trader X, however, takes profit after a 0.25% fixed position size, while Trader Y requires 0.5% for profit-taking. Compare the two after 100 trades, 50 winners and 50 losers. Trader X gains 12.5% from winners, loses 6.25% from losers, and pays 5% in spreads, for a total return of 1.25%. Trader Y gains 25% from winners, loses 12.5% from losers, and pays 5% in spreads, for total earnings of 7.5%. Indeed, to earn the same as Trader Y, Trader X would have to make no fewer than 600 trades, and spend 30% in spreads. Stop thinking about losses in pips. As we express stop-loss orders in price terms, it is tempting to think of losses at price terms too, that is, in pips. Yet, in the forex market, or in any market for that matter, we do not win or lose pips. We win or lose money. Each trade risks part of your capital. The amount of capital risk should also be broadly consistent across all positions. You can only achieve this consistency by varying the position size. So, once you determine the appropriate stop-loss level, you adjust the position size so that a loss would consume no more than a set money amount. It is wrong to set the stop-loss level as a function of the available capital. The adjustment must always be via the position size. Managing risk through position size. Before you begin trading, you must decide how much of your capital you are prepared to risk on each trade. You should take risks in consistent amounts, for example, a fixed percentage of your starting capital. For instance, if you decide to risk 2% of your starting capital on each position, you could theoretically incur 50 consecutive losing trades before your entire capital is exhausted. A total loss would be a disappointing outcome, precisely the result robust risk management is supposed to help you to avoid. However, this outcome would owe as much to a demonstrably inferior strategy as to risk management. An alternative approach to sizing positions is to choose a fixed percentage of your remaining capital. For example, if you decide to risk 2% in your first position and you lose, you can only risk 2% of the remaining 98% in the following position. As the capital account shrinks, so do the position sizes, and vice versa. The advantage of this approach is that 50 consecutive losers would not erase the entire account, just 64% of it. The trading strategy is still inferior, but it did not cost your entire capital to find this out. The disadvantage is the hurdle to a return to profitability. 50 consecutive winning trades of the same magnitude would not bring you back to the starting point. Finally, if you trade currencies using technical indicators, you will enter and exit positions based solely on the signals from a trend, momentum, or other mathematical methods. In this case, you must trade a fixed position size that considers the starting capital and the historical performance of the indicator. With technical signals, one cannot know the objective or the stop-loss in advance. It depends on how the indicator evolves. A single winning or losing position could yield many multiples of the others. If one loses when position size is large, thanks to abundant capital, but wins when position size is small, due to diminished capital, one might never become profitable. Managing risk consistently. Whichever position sizing approach you choose, you must be consistent. It is a mistake to modify the risk amount hugely from position to position. Sometimes traders are tempted to change the amount of money at risk because they are in a good, bad mood, they have been lucky, unlucky in the markets recently, or because something else is happening in their lives outside of the market. Unless one knows for sure the outcome of the next trade, the application of risk inconsistently is not a good idea. Be conservative with trailing stops. A stop-loss order must never be pushed away, but, over the life of a position, it may be brought closer. When prices move in a favorable direction, it is prudent to reset the stop-loss order to protect the unrealized gains, or, at least, to reduce the risk to capital. The adjustment of a stop-loss order to at least partially reflect the positive evolution of a trading position is known as trailing the stop-loss. For instance, a trader who sells USD by CHF short at 0.9800 for an objective at 0.9500 might give an initial stop order at 0.9900. If the dollar falls to 0.9650, halfway to the target, it would be wasteful to watch the dollar climb back to the original stop loss. It is prudent risk management to trail the stop loss lower and thereby reduce the risk associated with the worst case. It is difficult to say which level one should choose for the new stop loss, but it should be meaningful. As with the original stop loss, it must be a price that indicates we are now wrong, and it must not have been recently traded. Often traders hastily trail their stop loss to the entry price to avoid any loss at all from the position. However, the entry price might not satisfy either of these prerequisites. A systematic, rather than a gut-feeling approach to trailing stop losses is best. A consistent method at least allows comparisons between varying degrees of aggressiveness. Typically, conservative use of trailing stop losses is better. Know when to take a break. Trading is mentally exhausting. One can feel powerless in an uncertain environment, overwhelmed by an endless string of sometimes ambiguous information, and exposed to repeated losses. Sometimes it can all be too much. Even for technical traders, whose indicators and pattern recognition tools create some psychological distance between them and their positions, the forex market can be a fearsome place. Periodically, you will need a break. Create an alert in terms of calendar days, the number of trades, or performance achieved to remind you to stop. Use the time to look back on your past behavior and learn the lessons. Summary: only those who have never taken risks have never lost. Losing is an unavoidable part of trading. Yet, some straightforward rules and disciplined behavior can help to prevent a loss from becoming a disaster. Taking a loss is psychologically difficult. Always use a stop loss. Stop loss levels, even trailing stop losses, must be meaningful. Profit objectives must be significant multiples of typical bid-offer spreads. Risk capital consistently.